Welcome back to Investing Talk Podcast.
Today we're looking at Metalpha Technology. This is a highly specialized digital asset wealth management firm that's really undergone a dramatic transformation. The big question is, with all the volatility and this massive recent pivot, is it actually a good time to buy now?
That is our mission today. We're going to unpack all the sources we have, strategic, financial, technical, on this company. And hey, we want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, definitely leave it in the comments below.
So let's get into the analysis. When we talk about Metalpha Technology, we're really talking about a successful corporate metamorphosis. It's just not the company it was even a few years back. It has fundamentally repositioned itself. It's a premium service provider now in the digital asset wealth management space, and they're primarily targeting sophisticated investors.
Right, and that pivot wasn't just theoretical, was it? I mean, it really shows up in the numbers for fiscal year 2025. Pretty staggering way.
Staggering is definitely the right word. Revenue hit $44.57 million in FY 2025. Now, just for comparison, that's a 166% year-over-year jump from the $16.76 million they reported the prior year. We are seeing sustained triple-digit growth at a scale where it's just impossible to ignore.
Okay, triple-digit revenue growth is exciting, definitely. Yeah. But, often that comes with huge losses, right? Especially for younger companies expanding aggressively.
Yeah.
So what does this growth actually mean for the bottom line? Is this revenue, high quality?
It really seems to be. It's high-quality revenue precisely because they've achieved operational leverage so quickly. They weren't just growing sales, they were converting those sales efficiently into profit. In the prior year, 2024, they reported a net loss, remember, $3.68 million. For 2025, they completely swung it around, reported net income of $15.89 million. That translates to earnings per share of $0.41. This really signals that their model, catering to institutional high net worth clients, it's inherently high margin and highly profitable once you hit scale.
Yeah, and that profitability, you can see it confirmed when you look at the margins too. Their gross profit expanded to $21.30 million. That pushes their gross margin right up towards, what, 50%? Well, just don't get 50% gross margins unless you're selling intellectual capital and bespoke service, not just basic transactions.
Exactly. It's premium financial engineering they're delivering. But let's just step back for a second and look at the foundation that's sustaining all this growth on the balance sheet. Because, in the volatile world of digital assets, financial strength isn't just nice to have. It's absolutely critical for institutional trust.
And this is where the story gets really compelling, I think. They hold a massive reserve of liquidity. We're looking at $236.72 million. That's in cash equivalents, and short-term investments. That's basically a fortress balance sheet, especially for a company this size.
Right. And when you pair that liquidity with their really minimal debt position, total debt is only about $305,910, you get a near zero debt-to-equity ratio. So for you listening, this means the company has almost zero financial stress. If the market environment suddenly got worse, they've got a 2-year operational runway just covered by cash. That offers exceptional resilience.
Okay, but I did see one number that kind of stood out to me as a potential maybe red flag when looking at their operational health. The trailing 12 months operating cash flow is negative. It's showing negative $16.79 million. If they're making money on paper, why is cash actually leaving the door operationally?
That's a fantastic, really critical question, and it's important we frame it correctly. The negative operating cash flow isn't really a crisis because it's being comfortably absorbed by that huge cash pile we just talked about. It indicates they're in a heavy investment phase. They're building infrastructure, acquiring talent, expanding their regulated licensing footprint. All that requires upfront capital spending. It's really an investment in scaling the future business, not some kind of cash crunch.
Gotcha. So the negative cash flow is more of a planned investment, not a sign they're struggling. That makes sense. And if we want to confirm how effective those investments are, we should look at their efficiency metrics, right? Their return on equity, the ROE, it's just, it's eye-popping. 59.52%.
Yeah, that ROE is impressive for any financial institution, let alone one going through such a massive pivot. And for those wondering why this number matters, ROE basically measures how effectively management is using shareholder money to generate profits. An ROE approaching 60% suggests management is maximizing every single dollar you, the investor, have put into the company. They're performing at a staggeringly efficient rate.
Okay, so the financials seem really sound. Let's explore the qualitative side, the moat they seem to be building. You mentioned their strategic position in Asia. Why is being based and focused in Hong Kong such a big deal for a crypto wealth manager?
Oh, it's all about regulation and legitimacy. Hong Kong is actively trying to establish itself as a global hub for compliant, regulated digital assets. So by being positioned there and getting the necessary licensing, Metalpha technology creates really high barriers to entry. Competitors can't just pop up overnight. They need time, capital, and that crucial regulatory approval. This regulatory clarity gives them a competitive edge that's almost impossible to replicate quickly.
And their focus on institutions rather than, say, retail consumers must feed into that mode as well, right?
Absolutely. Institutional investors demand rigorous compliance, stability, and scale. It's a different ballgame. Metalpha offers this full-service platform, wealth management, derivatives, proprietary trading, which appeals directly to high-net-worth individuals and institutional clients. This client base brings in premium fees and offers significant scalability. It creates a stable, high-value asset base for them.
And we've actually seen some external validation for this strategy, which often speaks louder than the internal numbers, doesn't it? I'm thinking specifically about the talent they've brought in and the partnerships they've announced.
Yes, let's look at that institutional stamp of approval. It's important. The strategic partnership they announced back in August 2025 with Amina Bank, that's a specialized Swiss crypto-focused bank, to launch Principal Fund IR. That's huge. It instantly boosts their global distribution capabilities and, frankly, their credibility. They're working with established global names now.
Yeah, and the talent acquisition really reinforces that institutional ambition. In July 2025, they brought on a former Asia head of Rothschild. Now, this isn't just hiring someone smart. It's a signal, right? It signals that top-tier execs from traditional finance see Metalpha technology as credible, legitimate, and massively promising. When traditional finance starts crossing over like that, it really validates the whole enterprise.
Definitely. So, given all this operational and strategic success, the next logical question has to be, if the company is this good, why is the stock price still, well, so cheap?
Right, the stock's currently trading around $2.94. It's been volatile, sure, up 267% from its 52-week low, which is massive, but it's still trading, what, 29% below its recent highs? So the market has started to notice the turnaround, clearly, but there seems to be a massive valuation gap still, an asymmetry, as analysts like to call it.
And the core of that valuation gap really lies in the price-to-earnings ratio. Despite the huge growth and the profitability we've talked about, Metalpha Technology has a PE ratio of only 7.17.
Let's break that down a bit. Why is that 7.17 PE ratio so important for listeners to grasp?
Because it's just drastically discounted. A company growing revenue at 166% and achieving profitability in a cutting-edge sector like digital assets, it should command a premium valuation. Comparable high-growth fintech peers, think about successful payment processors or maybe asset managers, they often trade between 15 and 30 times earnings, sometimes even higher. The market just isn't fully recognizing this company's transformation yet, it seems.
So if the market simply re-rates the company, gives it a multiple more in line with its growth trajectory, let's say even a conservative 15x earnings, the theoretical upside potential is pretty substantial, isn't it? That could drive the price toward maybe the $6 to $12 range. The fundamental improvement has just dramatically outpaced the stock price recognition so far.
Exactly. That's the potential for a valuation re-rating, which is a major catalyst in itself. But we also spotted a highly unusual technical indicator that investors might find interesting. The stock has a negative beta of negative 1.03.
That is fascinating. So beta measures how correlated a stock's price movements are to the broader market, like the S&P 500. A negative beta means Metalpha technology tends to move sort of inversely to the overall market.
Precisely. In simple terms, when the traditional stock market is having a rough day, this stock, which is influenced more by digital asset trends and its own specific catalysts, might offer diversification benefits. It potentially gives an investor a bit of a hedge, maybe performing well when the broader tech sector is weak, if the underlying crypto market is supportive, of course.
Okay, this is clearly a compelling story, but no investment is without risk. When we look at the source material, what are the main headwinds Metalpha technology is facing right now?
Well, the first one is just inherent market correlation. Yes, the negative beta offers some technical diversification, but the core service digital asset wealth management is fundamentally exposed to cryptocurrency market volatility. A severe, sustained crypto bear market could easily reduce client activity, shrink their assets under management, and pressure their fee-based revenue. That's true regardless of how efficient they are.
And regulatory risks. They never truly disappear in this sector, do they? Even though Hong Kong is favorable right now, Global regulatory actions can still impact institutional sentiment worldwide. A clampdown in, say, Europe or the US could dampen the mood, even if Metalpha isn't directly involved.
True. And we also see increasing competition. Success attracts attention, right? Traditional financial institutions are rapidly trying to get into the digital asset space, and plenty of crypto native firms are scaling up quickly too. Maintaining their edge requires constant innovation. They can't rust.
And given their small size, there's probably a key dependency risk too. The company operates pretty leanly, only 25 employees mentioned. So if crucial executives, especially those recent high-profile hires, were to leave, it could materially disrupt client relationships and operations. Client concentration could also be a risk. If just a few large high-net-worth clients decide to leave, it could dramatically impact quarterly revenue, couldn't it?
Absolutely, those are valid risks to consider, but we have to balance those against the catalyst that looks set to materialize quite soon, like within the next 3 months. The most critical event coming up is the Q3 fiscal year 2025 earnings release. That's expected around mid-November.
Right, this report is the real test, isn't it? The transformation we saw last year needs to be confirmed as sustained momentum. If they maintain or, even better, accelerate that triple-digit revenue growth rate, that could really trigger the valuation re-rating we talked about.
Yes, confirmation of sustained revenue momentum is, frankly, non-negotiable for the bullish case here. Then, following that, there's a more technical catalyst. The ETF quarterly rebalancing, usually towards the end of November. Given their sector outperformance, there's quite a bit of speculation about potential inclusion or maybe increased weighting in major sector ETFs. If that happens, it forces immediate institutional buying, which can move the needle.
We also need to keep an eye on updates on their partnerships, like how is Principal Fund I performing with Ominta Bank? Strong early performance there would validate their investment management skills and likely attract further institutional money, acting as a powerful growth engine.
Definitely. And beyond those sort of operational catalysts, the market is buzzing with speculation about M&A optionality. As a leading regulated platform in a desirable place like Hong Kong with that fortress balance sheet, Metalpha Technology is often rumored as a potential acquisition target.
Yeah, you could see a regional financial conglomerate wanting instant licensed exposure to digital assets. They could easily justify paying a premium to acquire this platform. That M&A possibility often creates a sort of floor under the stock price, maybe providing some downside protection even if the market gets choppy.
So pulling all these data points together, the profitability pivot, the super strong balance sheet, the Asian regulatory moat, and that massive valuation discount the overall analysis from the source material points towards a highly bullish verdict.
That bullish view seems well backed up by the numbers we've discussed. So what's the optimal time horizon for a listener considering this opportunity?
Based on the upcoming catalysts, the strongest risk-reward seems to favor the medium-term investor, sort of that 3 to 12-month window. This time frame should ideally capture that catalyst convergence, strong earnings release, hopefully, and the subsequent market re-rating. It's targeting maybe an initial $5 to $7 price range.
And what about the investor who sees this as more of a long-term play? Someone betting on Asia's regulated digital asset future?
Well, for the structural growth investor, the potential is, frankly, much larger. If they execute well, if they scale successfully and capitalize on this massive expanding market for digital asset wealth management in Asia, the source material suggests potential returns of maybe 15 to 40 times over a 3-year plus horizon. This could position them as a major player in the next evolution of finance. It's ambitious, but possible. Ultimately, the critical factor for you to monitor is whether Metalpha Technology can keep up these impressive triple-digit revenue growth rates into 2026. The story of transformation is pretty much complete now, but the story of execution really starts now. And those upcoming Q3 earnings in November, that will be the first major test of that sustained momentum. That's what we'll be watching.